also going to bring in Lori Calvasina of RBC Capital Markets, who joins us here on set. Lori, it's great to have you. We've been talking about it for the better part of a week or so, this rotation out of the mega cap tech names and into other parts of the market. And yes, everything finished the day lower in terms of the major averages, but the Russell 2000 outperformed versus the S&P yet again. Is this compelling?
It is. And you know what's funny, Morgan, is right around when 10-year Treasury yields peaked a little bit under 5%, started to come down. People were like, OK, interest rates have peaked. What do we buy? And there was really kind of a willingness once we started to get the softer CPI prints, kind of the hotter unemployment numbers. People were like, OK, what the Fed has wanted to happen is happening. So now we can count on the Fed to cut. And small caps have been an intrinsic part of that conversation. I would say over the past month, I'm having conversations with people about small caps, not just small cap PMs. They always want to talk about small caps, but people who are looking at the small caps as a sentiment barometer, as one of those possible destinations for the rotation out of the Mag 7. And what we're seeing is really a willingness, even from tech investors, right, to explore alternatives for things like energy, things like small caps. Obviously, energy's having kind of a rough time, but this is just a really refreshing, kind of equity story over the last month where people really finally seem ready to do something different.
And does that carry over to 2024? And perhaps just as importantly, when you look at the S&P 500, 45.49 is where we ended the day. You've got a price target for next year on the S&P, the broader market, that represents about 9% upside from here, 5,000. Is that what's going to propel the broader market into 2024 as well?
I think you're going to still see some choppiness in terms of leadership. I mean, I think one of the reasons why it's been so difficult for the growth trade to really kind of relinquish its leadership is that expectations for economic growth are still sluggish. I think one of the potential triggers for small caps to really get going is for people to ratchet up their economic expectations. Right now, GDP is still expected to be about 1.2% next year. Talked to a lot of investors who are skeptical the number is going to be that low, that we could see things revised up. And if you see that, I think you'll get more of kind of a lift to come of these cyclical, beaten up areas and kind of the safer, more defensive secular growth names. I don't think they're going to do horribly, but you just may not see incremental buyers for those stocks.
Mike Santoli, next year is 24, it is an election year. What does an election year do potentially to markets, especially one that's looking as action-packed as this one?
Well, typically, the market is somewhat held in check in the first part of an election year. I know there's various ways to slice this. I always also say, in terms of modern market history, if you want to talk about since World War II, it's been like 20 elections, right? It's not necessarily a statistically significant sample of here's what happens, but usually there tends to be a little bit of a stalemate in the market as we try to figure out policy implications. So you get some rallies into the election and then some, again, choppiness right around it, and then clarity there afterward and some relief. So if it all follows the script, that's what you would expect. But I mean, I can go back to a year like 2012, which came after a really harsh correction year in 2011, and it was a pretty smooth ride to the upside with a couple of modest pullbacks, and that was an election with an incumbent president as opposed to one at the end of a second term. So all of it can get thrown into the mix, and I think it's always safe to keep your expectations relatively muted as you go into an election year and understand that it's not just going to be the pure observable fundamentals that are operating on the market.
The fact that WTI flirted with $70, Mike, even dipped below it at one point. We saw energy, the worst performing sector in the S&P today. I mean, as we talk about this soft landing narrative that's, at least for now, intact based on the macro data we've been getting, what is the energy market signaling, and is it in contrast to that?
I don't know that the price of crude is necessarily foremost sending a macro signal about the strength of the global economy. I mean, today you did actually have an inventory draw that was greater than expected in crude because refineries were running heavy, and so production is in play. And so I'm inclined to believe what the futures curve says, which is this is an oversupplied market in the short term. I don't think it's because economies are falling off a cliff. Maybe that changes if you really catch some acceleration to the downside in the price. But you're basically flat on a 2-year basis. And we were at this price when the economy was kind of reawakening a couple of years ago. So I'm not that concerned about that as a signal right now in terms of growth.